definitely have some good options for our investors to get into a property under a fix and flip loan where the property would otherwise need to be purchased with cash, and renovate the property to whatever standard we need to renovate it. Hopefully, rent the property or get it rent ready, and then refinance into a permanent loan, a term loan, which is typically the DSCR that we just went over. So DSCR, very popular. Of course, most investors that are working on a project where the property may have condition issues and maybe needs to be brought up to code, they would need a fix and flip loan to then get ready for a DSCR loan for the permanent loan. So DSCR that we just went over, most popular takeout method after the fix and flip, but a lot of investors need that fix and flip help. So Jose, if you're ready, let's go over how we can get these investors into a fix and flip program.
All right. Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. We definitely love using these fixed flip loans as one of the instruments that we offer to our investors. Obviously, what follows the fixed flip loan, if the investor wants to keep the property as a rental, is the DSCR loans that Nick just went over. It makes it a lot easier when those investors own multiple properties, especially taking a whole bunch of write-offs. The DSCR loans tends to be the more viable option. However, that does not mean that we do not offer the lowest cost option, because if there is a lower cost option than the DSCR, that is the one that we would offer. But those DSCR loans rates are smoking. The other thing to consider when this overall strategy for the investors is seasoning on title, right? We have DSCR loans where you can do a cash out refi with 0 months seasoning on title. On title today, you can refinance tomorrow with a cash out refi and get the market value versus a purchase price. Now, obviously, that wouldn't be the scenario usually for the rehabber who's going to need to rehab the property. That's going to take some time. But it's what's very exciting for them is they love the options that we have. We have an option with no seasoning. We have an option with 3 months seasoning. And then we have an option with 6 months seasoning, which is more the standard. And then there's a couple of options out there with 12 months seasoning. But obviously, those aren't the ones that they usually select. So let me share some options here with you right now. Biggest thing to consider when you do have the fixed flip loan is the experience level of the flipper, right? Because that's, if they have 0, that's going to determine if they're even going to be able to do it, because considerations are experience level, the profit in the deal. The profit in the deal essentially is the income. That's how they're going to view income. And then credit report. So 3 major components there: experience level, profit in the deal, and the credit score of the borrower. All will determine if the deal will happen. You can't have scenarios where you have 0 experience, like the one I'm going to show you right here, but due to good credit and good profit in the deal, they'll do it. On the other hand, you could have good profit in the deal, no experience, not such good credit, and they're probably not going to do the deal, even if the borrower's credit may meet the minimum requirement. Remember, that's the minimum requirement, and then the other 2 components have to be taken into consideration. So I have 2 examples to share with you today here. The same exact scenario. The only thing that I did was just change the experience level of the borrower. So in this first scenario, we have 0 flips in the last 3 years. We have a purchase price of $115, rehab budget of $26,000, and an after repaired value of $210. So that's a pretty good flip right there. There's a lot of meat on the bones there. So the total loan amount on this deal is $112,250. That's going to include $26,000 for the rehab budget. So it's 75% LTV there is what they're actually lending the borrower. And you would just have to do the math and subtract, but it is 75%. And then total loan amount is 112,250, and total estimated liquidity requirements $36,163. And did I not put the rate on here? Okay, I may have forgot to put the rate, but it was 11.99% on that one. But the main thing to note really on this loan is just the flippers really aren't looking so much at the rate as much as what are they going to be able to get. And in the next example here, this one is 10.49% interest rate. So the rate drops 1.5%. But the main thing to note in this scenario here now, this investor has 3+ flips in the last 3 years. Same deal, same ARV, but the difference is the initial advance on this one is 85%. So there's going to be an initial advance at closing of $97,750. So due to the increased experience level of this investor with 3+ flips in the last 3 years, we get 10% more initial advance at closing. So our borrower has to put 15% down at closing. We're still getting $26,000 for the rehab budget funded. So we're funding 100% of our rehab budget. And the total estimated liquidity required is 29,775.12. That's what they have to show in the bank. That's going to be for their expenses. So again, 29,775.12. It drops about $7,000. But the main thing here is our borrower is going to be able to get into the property with 15% down payment, 15% of the purchase price, and funding 100% of the rehab. So it's a win-win situation here for the borrower. And this is a much more cost-effective method of doing this rather than just putting it on your credit cards. Because unfortunately, if you put it on your credit cards, when you go to try to get that funding, or if you put a little bit on some smaller loan and rack up your credit cards, when you go to get that exit loan out of the flip loan and into the DSCR loan, your credit is going to be shot because your credit cards are going to be overextended, and then you may not be able to get the loan to value that you need to be able to exit this loan. And then you will either have to get a business partner to come in with good credit and hope that you can get the refi, or sell the property. So understand that these loans not only aid the financing of the rehab, but they also protect your credit so you don't rack up the balances on your credit cards, and then so that you can maintain your good credit score to have more viable options for the exit loan out of this one, and for the additional purchases that you want to do once you get your rehab and purchase money back, which is the idea, so that then you can repeat the whole process.